tax man. Give me some time, about a month or two should do me just fine. I teach for a living and you know what that means. I can't afford even wieners and beans. Tax man.
Hey there, thanks for stopping by. Quite often I receive emails, questions from clients. The phone calls are always the same. Well, what are these tax advantages that I'm going to receive buying this house? How much of a difference does it make? It really depends on the person. It depends on who you are, where you live, what you do. Instead, what I'd like to do today is go over a few different income levels, different income structures, and just give you an idea of what the tax benefits are at different points financials. If I'm going to start out around $50,000 and I'll work up. I'll take someone single. I'll take we'll go from 50 to 75 to 125, and then I always have to keep in mind, I've said it a million times and I'll say it again, that when it comes to tax planning and it comes to tax issues, you can't keep them isolated. They can't be in a vacuum. That said, you have to keep in mind what AMT phase out points you're into or going to be coming into, what your credit phase out situations are, whether you're having kids, whether your kids are going to college. All of these issues, they stack up on each other and help us to paint the picture. But as long as we have a decent foundation for each of these issues, how they come and how they can affect us, hopefully we'll be doing okay. So now I'm going to turn over here to my computer. I'll bring in on a screenshot, and what we have here is I just have a flat line return. The guy's name's Joe Taxpayer. He lives in Dedham, Mass. He's single. As you can see here, he's a single guy. He doesn't have any dependents. Any dependents would be going here in your tax return. And I have a very flat out, straight up $50,000 W-2 wages. He's taking a standard deduction. This is a 2009 return I'm using. 2010 will be hopefully slightly better. When we buy a house, we're only looking to reduce that to increase that $5,700. We're trying to get a bigger number because that's going to offset our income. You notice that our $50,000, the $5,700 is subtracted off of that, and it brings us down to $44,300. Then after we take our exemptions, we're going to come up to our taxable income. And from that taxable income, if you've ever looked at the IRS worksheets or the calculation tables, with that taxable income, that is, you just go into the table and you look up your tax. In short of having credits that are going to offset that tax after it's calculated, that's pretty much your bottom line. Expenses. Well, medical expenses, even if you had a lofty $2,000 medical expense, phase out and the limitations for medical expenses require that they exceed 7.5% of your adjusted gross income. So even in the case of someone who earns $50,000, 7.5% is $3,750, meaning that you're not going to get any, you see this line 4 here, you're not going to get any actual realized benefit from those medical expenses. And also keep in mind, this is another thing that sometimes folks don't really understand. If you beat that number, if you beat the $3,750, it doesn't mean you get everything. If you beat the $3,750, you get a $1 deduction. What about $2,500? This is the state taxes paid in, that is an allowable itemized deduction. So in this case here, we have the principal residence, so you would be able to deduct the property taxes that you pay on your residence, additional homes, sometimes, and generally excise taxes on your vehicle, which anything that is a valuation-based tax is usually something we're going to be deducting as well. Interest paid is another huge part of the home ownership constituent. Our charitable contributions, and then the always elusive, and check the videos, there's plenty of info on them, miscellaneous deductions that include the employee expenses and these deductions are limited by 2% of your income. So even in this case, you would have to exceed $1,000 in employee business expenses or other miscellaneous deductions. All this taxpayer has is the $2,500 that they paid into the state. That is their itemized deduction. $2,500 is certainly not better than $5,700. In this case, you're just going to be taking the standard deduction because it's a free number. Make sure to check out my videos on hedging and shifting deductions when it's possible to try to utilize this the standard and the itemized deductions to your advantage until you buy a house. Okay. So, Joe Taxpayer, we have, with the standard deduction, he's looking at an income tax of $6,356. Some states you will be able to itemize. Some states use the federal itemized return to determine determine your tax liability. So that is something to take into consideration. But we'll have a fair idea where we're headed just by doing it via the federal return. He's paying effectively 11.91% tax on his income in the 25% bracket. What that means, the difference between those two numbers is the 25 bracket means the next dollar that he earns is his marginal tax rate, and the next dollar that he earns is he will be taxed 25 cents on that dollar because you're sitting in that 25% bracket. The effective tax rate measures the overall tax. If we take the entire salary versus the bottom line tax, we're paying about 11.91%. One easy way to do this, to figure out your interest payments, you can actually shoot over to Scuttle or Swim, and there is a mortgage calculator in the sidebar. If you go down, there's an affordability calculator, closing cost estimator, mortgage calculator. I'm going to say in this case that a fair purchase price for a home, quote unquote, in this area, and I tend to lowball, but about $300,000. A down payment, I can't realistically say that somebody's going to be able to come up with 20%, so most likely it's going to be a 10% down payment. 30 years at 6%, that sounds fair. So in this case, a 6% note for $300,000, well, we'd be looking at financing $270,000 with 10% down. We're looking at a monthly payment of $2,118.79. If we look at year one and year two, year one we have interest paid of $11,100, and year two we have $15,900. So to be fair to the first 5 years, since on an amortization schedule our effective interest paid every year is going to drop, but it's not until you get pretty far into a 30-year note that it really starts sliding down. I'm going to call the interest $15,500. $15,500 in mortgage interest, and we were to allocate $3,000 in property taxes, and that would get added to the state taxes we had already paid. Since we're already over that standard, if we had those smaller expenses that didn't add up to exceeding the standard deduction by a great deal, they would at this point in time. What's our bottom line here? Because this is all that really matters at the end of the day. With $21,000 in itemized deductions, our taxable income is going to be lowered substantially, and our income tax is going to be dropped down to $3,389. Okay. Effectively, that was the tax savings. We're looking at about $3,000. So now at $75,000. Another thing that we change logically would be the state withholding, the income tax withholding. We call it about $3,750 paid into the state. That's going to raise that itemized deduction in itself. The baseline tax with the standard deduction would be $12,606. We added our $3,000 in property taxes, our $15,500 in mortgage interest. Our itemized deduction is slightly higher. Reason being, we have more state tax withholding. If you're earning more, you're going to be paying more in. So our income tax is dropped down to $8,469, just shy of a $4,000 difference. So now we've jumped up to someone with an income of about $125,000. So before we account for our mortgage interest, we have a baseline tax of $25,878. First thing that you're going to notice here is that their state income taxes, I heard they're quarterlies paid, or in the case that we're not paying our quarterlies, the amount that we paid with our return when we filed it in April. You're going to notice that they're already itemized. They're already over that point. So anything that comes in, as long as it's not subject to AMT or other phase-out limitations, is going to be gravy. It's just going to help. And we put in our $3,000 property tax and $15,500 mortgage. Because again, our itemized deduction is substantially higher, $25,000. Taxable income, our tax derived, is $20,705. We're slightly more than a $5,000 benefit bracket. This individual, I mean, he's in the 28. And being in the 28, we're offsetting a higher tax rate. But even our example at 50, they were hovering in the 25. Someone with a lower income, they might be hovering at the 25 and go into the 15. So it's not as great a tax benefit when it comes to figuring out, how much is a house going to be worth to me. I usually say figure about 2 payments. In this case, we'd have 2 payments would be about $4,236. So my two payment estimate for the $50,000 annual income is slightly low. But as we get to the 75, 125 point, it becomes a lot firmer. Ballpark 2 payments will come back in your pocket. You have to examine the cost benefit when you're purchasing a home. Well, first of all, you're not going to be paying a mortgage forever. It might seem that way, but 30 years in, or even 15 years in, you have equity in that house. You own a portion of it. When we're trying to calculate the benefit of real estate in the short run, so in this case, I had already included the property taxes, home insurance, and in our example, I had thrown PMI into our calculation. So the 2118 is my actual operating overhead. Say a fair rent here would be about $1,600. So you'd be looking at $19,200 annually. And here we have a payment of 2118 over 12 months, $25,416. So if I take my $25,416 and I subtract my $19,200, I'm left with $6,216. On our lower end, we have a tax benefit of $3,000. On our upper end, we have a tax benefit of $5,000. So when we throw the tax benefit in, the additional cost is going to be between $1,000 and $3,000, dependent on income. There's a lot of other things you need to consider when purchasing a home, but I think this might give you a decent idea of how much it helps you. Essentially, you're almost in the same position you would be as a renter. Well, thanks for stopping by. I hope you got something out of this. Feel free to shoot any questions over to Scuttle or Swim, and I'm sure they'll hit me up if there's something I can help you with. Thanks again.
Do me just fine. I teach for a living and you know what that means. I can't afford even